Hello, everyone, and welcome to our second in our series of webinars for the education sector. My name is Michael Kutri, and I'm one of the audit partners in the Brisbane office of BDO, who specialises in audits in this sector. By the way, if you're experiencing any issues with being able to hear anything or see any of the information being presented, reach out to us via the chat box, and we'll look into it as soon as we can. We've run a number of tests yesterday and today, but we're hoping that there should be no problems. So, today we're talking about AASB 16 leases, and this standard is likely to have a significant impact on the not-for-profit sector in general, with some unique issues within the education sector. So also throughout this session, please feel free to send questions. We'll try and see if we've got some time at the end to get to them. But regardless, if we get time to look at them through this session, we'll get back to you with as much information as possible at the end. You'll also receive a link with this recording, so if there's anything you've missed or something you want to go back and have another look at, you'll get the opportunity to revisit it as well. So today we're going to look at why we have the standard, what is a lease, when it's effective, when AASB 16 is effective, what impact does it have on the sector, when you need to start considering the impact, key inputs for some calculations, some examples of the potential impact, transition options for AASB 16, and are novated leases captured by the standard, and some strategies to help reduce the impact. So why do we have this standard? You can thank Sir David Tweedy for this one. He was the chairman of the International Accounting Standards Board for 10 years, ending in 2011. And as you can see from this quote, it was his life's ambition to ensure airlines recorded the planes they were using on their balance sheets. He was actually the initial chairman of the International Accounting Standards Board, and taking into consideration this quote was from 2008, you can see how long it's taken to have his ambition fulfilled. And a small fun fact is that he was inducted into the American Accounting Association Accounting Hall of Fame in 2013, but I can assume that no one from the not-for-profit sector voted him in, that's for sure. So from this quote, you can see that the main reason for the introduction of this standard was to capture large commercial operations from trying to manipulate their balance sheet by structuring arrangements in a certain way. During the development of the standard, additional reasons were then found as to why this would be a good idea, and this stems from ensuring there is greater consistency in financial reporting no matter how you decide to fund your operations. Two entities, say for example, both identical in every way, but one funding a building via an operating lease and the other via a finance lease, will have significantly different balance sheets and some differences in their operating results. Now, I would expect that any knowledgeable person reading a set of financials would understand the difference, as there are disclosures included in the financial statements about this, but the International Accounting Standards Board took the view they wanted consistency, so here we are with this newer standard about to be applicable. And as I mentioned, it does appear the standard was drafted for large commercial operations, and you can see that from going back to the original quote, that was its main objective. Unfortunately, this has now created some unique issues in the not-for-profit sector. The new AASB 16 standard introduces a single leasee accounting model where all leases will be accounted for in a similar manner to the way in which finance leases are currently accounted for, with some limited exceptions. So what is a lease? AASB 16 contains a number of definitions. One of them is what a lease is. And this definition is a contract or a part of a contract that conveys the right to use an asset, the underlying asset, for a period of time in exchange for consideration. This definition makes reference to providing consideration, but what if you've been provided the asset for no consideration? Does this mean you don't have a lease under the new standard? Unfortunately, no. There is additional guidance in the standard in paragraph B9 that states you only need to have the right to obtain substantially all the economic benefits of the asset and the ability to direct the use of the asset for the period. This additional guidance makes no reference to any requirement to provide consideration, and this is why it is important to ensure you've considered all aspects of the standard in relation to your circumstances, as if you don't consider all the guidance material, you might make a decision on incomplete information. So the process to identifying a lease can be seen effectively from this diagram here. So you basically just go through and answer the questions to determine if you have a contract or an arrangement that is likely to be classified as a lease. So, is there an asset? Does it contain substantially all the economic benefits? Do you have the right to direct its use? If you answer yes to all those, it's likely you're going to have a lease. So when is this standard effective? It was actually issued back in 2016, so it's been a long time on issue with a long period before it became effective, but it is now effective for all entities with a reporting period beginning on or after 1st of January 2019. With the majority of the education sector entities being a 31 December year end, this would mean that the first year of application would be for the year ended 31 December 19. If you're a 30 June year end organisation, the first application would be for the year ended 30 June 2020. Early adoption is permitted, but it's likely a little bit too late for that now if you haven't already had processes in place to understand the impact. Additionally, you're also required to adopt AASB 15 revenue from contracts with customers at or before the date you apply AASB 16. So this is likely to mean more of a reason to see why you wouldn't early adopt the standards now. So we do have a quick poll question that we're just going to throw out to everybody at the moment. Just make sure I can get this working. Very simple question. Do you believe AASB 16 will have a significant impact on you? Simple yes or no answers is fine. But while you're thinking about your answer to that question, I will just go through a couple of things as well. So the answer is potentially likely to be yes if you have land or buildings that are provided at non-commercial terms, including peppercorn leases, arrangements where a nominal fee is paid, which is likely to be less than what a commercial arrangement would be. The land and buildings are owned by a related party provided without any formal arrangements. So a lot of people have sent their votes in already, so thank you very much for that. We've got significant yes representation there, which is sort of expected as part of the reason why you're also joining the call or the webinar. So yes, I do agree that this will have a potentially significant impact. So getting back to what we're talking about, there are a couple of exemptions in relation to the standard that will allow you not to record the leases on the balance sheet, and this will hopefully help reduce the potential impact. Now, those exemptions are in relation to if an asset is considered of low value or the lease has a short term. Now, low value hasn't been defined in the standard, but the guidance provided by the International Accounting Standards Board suggests that this would be for any item when it was new, it would be worth less than $5,000. That's $5,000 US because it was the International Accounting Standards Board that had created that advice. So even if you had a second-hand photocopy under a lease arrangement, that would be less than $5,000 at the time of entering into the lease. If it was more than $5,000 when it was new, it would still be captured under this accounting standard and then be required to be recorded on the balance sheet. But a lease that is bundling individual items where they would each individually be less than $5,000 is also able to be excluded from the standard even if the total of the bundled items is over that threshold. So say, for example, you're replacing all your computers, as long as each of the individual computers is less than $5,000, regardless if the total combined value is more than this, the lease would be allowed to be excluded from AASB 16 and you can elect to apply the previous operating lease accounting. And before you think that that's, we'll just break up all our assets into small $5,000 increments, there are clauses that deal with this. So you can't, say for example, break up a car into like an engine, its wheels, its doors, to try and get each part less than the threshold. There's clauses in the standard that encourage you not to do that, and there's some specific examples about that as well. So the term of the lease is the other potential exemption to think about in relation to this, and that's only if the term of the lease is 12 months or less from the commencement of the lease, after factoring in any potential extension options. But there's not likely to be many leases that are for less than 12 months, but the exemption's there if you can use it. So, as mentioned earlier, all operating leases will be captured unless they meet the exemption requirements. So leases or other arrangements that are likely to be captured will be land and buildings, high value IT equipment, photocopiers, servers, and any cars and buses that you might have. The main impact for most schools is going to be the leases or other arrangements for the use of land and buildings. And the reason I've mentioned or other arrangements is that the transaction does not have to be called a lease to be captured by the standard. If the terms and conditions of your arrangement meet the definition of a lease, then it will be classified as a lease. So when do you need to start considering the impact? So if you haven't started already, then it's time to think about it now. Where you have non-arm's length transactions, consideration will have to be given to what the fair value of the lease would be. This could lead to costs associated with determining the fair value, as you may need to engage a valuer to determine the fair value. If you have to change or enter into new contracts, this will take time to finalise, and some aspects of the standard are difficult to deal with. Therefore, you may need advice on how to treat your unique circumstances within the scope of the standard. And if you're a December year-end entity, you'll be when you prepare your 31 December 18 financial statements, you will need to detail the impact of the new accounting standards that are not yet effective, and this will include AASB 16. As AASB 16 will be effective by the time you sign your 31 December 18 financial statements, it might not be a good look for management to say that they are yet to assess the impact. So there are a number of inputs in relation to the calculations for the leases, and some of the key considerations to think about are the term, how to calculate the lease liability, how to calculate the right of use asset, the discount rate, and any requirements to remeasure if you need them. So the term of the lease, as per a finance lease, in the current standard, you'll be required to assess the term of the lease arrangement going forward, factoring in any likelihood for extensions. So if the lease term starts, when the asset is available for use, and the length of the term is then based on the non-cancelable lease period, any extension options, if they're reasonably expected to be exercised, and any any termination options that are reasonably likely not to be exercised. So a termination option would be where you enter into a 20-year lease with the right to terminate after 5. If you aren't reasonably likely to terminate, then the lease term would likely be 20 years. So we'll go through a simple example a bit later on in relation to calculating a lease liability. But once again, there are a number of factors that need to be taken into account when determining the value. I'm not going to go into too much detail in relation to these as they depended on the terms and conditions of each arrangement. So as long as you're aware of what might be included, this will allow you to gather the right information when undertaking the calculations. In a commercial arrangement, it's going to be a lot easier to undertake this calculation as this was the intention of the standard. Under a non-commercial arrangement, you might not be able to determine this, but we'll talk about that a little bit more soon. This slide I've just expanded a little bit some of the main items to be considered. In a peppercorn lease example, a number of these items will not need to be considered, but it's worth going through your contracts if you have one, that is, to see if you have anything that should be considered. Calculation of the right of use asset. As per the lease liability, once again, there are specific ways to calculate the right of use asset. This calculation is dependent on the lease liability being the starting point and then adjusting for the items, as you can see on the slide. It's important to be aware that the lease liability and the right of use asset are not always going to be the same value, even when the arrangement is at commercial terms. As mentioned earlier, under a non-commercial arrangement, you are not likely to be able to determine a lease liability. And if this was the starting point of the right of use asset, does this mean you can't calculate it? For cases like this, the calculation is turned around, and you have to work out the value of the right of use asset, which is generally going to be based on the fair value of what this would be in an open market. You'll see some of the complexities with this when we get into the examples a bit later on. Discount rate. So the discount rate to be used in determining the present value of the future lease payments is to be the implicit rate in the lease. But where this is not able to be determined, or the lessor will not tell you, you can use your income rental borrowing rate, being what interest you would be charged by a financier to borrow the funds you need to acquire an asset equal to the value of the asset you are looking to lease. Specifically, the definition in the accounting standards for the incremental borrowing rate is the rate of interest that a lessee would have to pay to borrow over a similar term with a similar security the funds necessary to obtain an asset of a similar value to the right of use asset in a similar economic environment. Therefore, one of the ways to minimize the impact of the standard is to use the incremental borrowing rate, as you can determine this rate yourself, as it will be unlikely a lessor will tell you the interest rate they are charging you. More importantly, in the case where this is not a commercial lease arrangement and the lease is being provided at below market rates, you would not have an interest rate embedded into the lease payments, as they are already below market rate anyway. So therefore, you would have to use the incremental borrowing rate in your calculations. As with all things where judgment is involved, there is a chance that the estimates you have used in your calculations will change based on new information. If this is the case, the standard requires you to determine the nature of the change, and this will impact how it is then accounted for. If there is a revision of the lease term or a change in the decision to exercise the purchase option, this will require a full recalculation of the lease liability based on the new assumptions, but also require you to use a discount rate as at the date of the reassessment. But if the revision is in relation to payments changing due to an index change or an estimate of the value of the residual guarantee, then you recalculate the lease liability, but using the same discount rate you used when you made the original calculation of the lease liability. Once again, there's lots of little unique things in these standards that you just need to be aware of. So if circumstances do change, please seek some advice if you need it. So let's look at an example. I've prepared a pretty basic one here just to go through what's going to happen. And then we will look at in more detail what happens if the circumstances change, in particular if there were no actual lease payments. But for this very first example, we're going to assume that this is a commercial lease with commercial terms, and then later on we'll revise that. So we have School A entering into a 3-year lease for a building with lease payments of $100,000 in year 1, and then increasing by $10,000 a year. So $100,000 in year 1, $110,000 in year 2, and $120,000 in year 3. The lease payments are made at the start of the year, and we have assumed no options to extend the term of the lease, and we've also assumed incremental borrowing rate of 10%. So under the current accounting standards, this lease would be an operating lease. And why? The lease does not transfer substantially all the risks and rewards incidental to the ownership of the building to the lessee. This is because the building has a 30 or 40 year life, and we're only leasing it for 3. And the way this would have been calculated should be as follows. So the lease is for 3 years with payments, as I said, $100,000, $110,000, $120,000. Under the current standards, you would calculate the average operating lease expense over the period of the lease. So in this case, annual operating lease expense would be $110,000 a year for 3 years. But under the new standard, this lease would be classified as a lease to be brought to account on the balance sheet, as it doesn't meet any of the exceptions we mentioned earlier. So it's longer than 12 months and it's over $5,000. Due to this, we would record this lease in a similar way we would record the finance lease, where you would have a leased asset which in this case will be the right of use asset and a liability for the future lease payments. The way this will be calculated under the new standard is to calculate the present value of the future lease payments to work out the value of a right of use asset. In this case, I've calculated that value to be $299,174, which you can see is the present value of each of the 3 lease payments. This amount would be required to be amortized over the period of the lease, being 3 years. Therefore, the amortization would be $99,725 per year, which is just the $299,174 divided by 3. I've also included calculations at the bottom of that slide to indicate the split of the lease payments between what would be interest and a reduction in the lease liability, remembering this is using the incremental borrowing rate of 10% as we detailed in the facts of the example. This calculation shows that there's no interest in the first year as the repayments are made up front, and then there's interest in years 2 and 3. So what does this look like in the profit and loss? Under the current standards, we would have had an operating lease for $110,000 per year for 3 years, and that's all. Under the new standard, we would have an amortization of the right of use asset and an interest charge. As shown in the prior slide, there's no interest in the first year due to the payment being upfront, but then interest in years 2 and 3. Although you can see it in this example, it would be clearer if the period was longer, but generally, the total expenses relating to a lease under the new standard would be more than the operating lease expense under the current standard at the beginning of the lease period because of the impact of the interest charges. And then the total lease expenses would reduce under the new standard to be less than the operating lease expenses of the current standard, with the net impact over the total life of the lease being exactly the same. So I've added in there like the cumulative totals, so you can see that after the 3-year lease period, there's actually no difference in the total expenditure, but annually there is an impact to the profit and it can fluctuate significantly. So the impact on the balance sheet, as you would expect, is now to have an asset and a liability that weren't previously recorded, but once again, at the end of the lease term, there's no difference between the current and the new standard. The total impact on the cash flow hasn't changed, which is what you'd expect, as the cash paid hasn't changed, but the difference here is just the way the payment is classified between interest and repayment of the finance lease. But what if there were no lease payments or something less than fair value? So using the same facts we used a little bit earlier, but this time there's no actual lease payment, the fair value of the lease payment will still be $330,000, as this was the commercially accepted lease value. The present value of these we also calculated in the prior example, which is $299,174. So we'll use this as our value of the right of use asset. This amount will be a debit in the financial statements, but we have no lease liability, so where does the credit go? Now this is where it gets complicated, if it wasn't complicated already, but you now have to move beyond AASB 16 and look to the revenue standards, AASB 1058 and AASB 15. And there are potentially 3 different treatments which are all based on individual circumstances. So the credit could go to a capital account, revenue, or be deferred revenue. So when would it likely be capital? So if the party providing the lease was classified as an owner under the accounting standards, then providing a benefit to the school may be seen as a capital contribution to the school. If this was the case, then there's a likelihood that the amount would be considered a contribution by an owner as an owner and be capital in nature. Therefore, the other side of the right of use asset, the credit, would go to a capital account. When would it be revenue or deferred, revenue or retained earnings? If the school had no obligation to undertake any service for the lease, then it would likely be that the fair value would be revenue in the year the lease was entered into. This could have a significant impact on the performance of the school, with a large revenue in year 1 and then continued amortization of the asset over the remaining years of the lease. Under the transitional rules for the application of the lease standard, there may be an option to make an adjustment to retained earnings. We'll cover this in a little more detail in a few slides' time. And when would it likely to be deferred revenue or a contract liability? If the lease contract you have entered into includes the requirement for the school to undertake sufficiently specific performance obligations, then there may be an option to record the credit as a deferred revenue, or to what's being referred to in the standards as a contract liability. The difficulty is that there is only some guidance on what is and isn't classified as a sufficiently specific performance obligation, but no detailed definition. We're currently trying to seek more clarity from the AASB on what would or wouldn't be sufficiently specific performance obligation, but we are yet to get this. And why is clarity important? Assume you've received some land and buildings on the condition you must operate a school. The current guidance would suggest this alone is not a sufficiently specific performance obligation, but if you're required to educate a number of students per year, this might be sufficiently specific. But how many students, and is this criteria enough on its own? So getting clarity on what would or wouldn't be allowable as a sufficiently specific performance obligation will enable you to structure your agreements taking this into account, and therefore having the ability to match your amortization of the right of use asset with the reduction of the contract liability. Although we're looking to obtain feedback from the AASB in this area, there might be an opportunity for the education bodies or a number of schools with similar circumstances to get together and produce advice for your very specific requirements. This can then be provided to the AASB for comments and verification that the way you're planning to apply the standards is in accordance with their expectations. So we have another quick poll question here. Just give me a second to get this one up and running. So what do you believe is the best option in obtaining clarity on what is sufficiently specific performance obligation? Industry bodies to obtain the advice on your behalf, each school to seek it individually, schools to get together as a group, wait for the AASB to provide more guidance, or we don't need any more clarity because we know enough now. While you're thinking about that, I'll just go back over the facts of the previous example that we're looking at, because we're sort of going to talk about that in a bit more detail now. So previously we mentioned that we have a lease that we have at no cost. We've determined that the fair value of that lease was $330,000, and the present value of this, and therefore the value of the right to use asset, was $299,174. So we got a number of votes in as well on this one. So thank you again for giving some information on this. So the results show that yes, the industry bodies, everyone likes industry bodies to get together, and then a bit of a split between some of the other results. And you know, we're also trying to work with the AASB on trying to get more information in this area as well, and we'll pass on any details as soon as we can get them. So once again, thank you very much for your feedback on relation to those polls. So getting back to the example we're talking about. So the impact on the financial statements in relation to where there's no lease payments would be to, once again, we have an amortization expense of $99,725 a year for the 3 years, which is that right to use asset. But due to the complexity of determining if you have that sufficiently specific performance obligation, the revenue is likely to be recorded upfront on the date of entering into the lease arrangement, which therefore would suggest you might have a revenue of $299,174 on year one, an offsetting amortization expense, but a large impact to your profit, as you can see there, which is increasing profit, which is a good thing. But unfortunately, in the years 2 and 3, you just have a negative impact to your profit because of the amortization expense. Now, obviously, that has a significant impact annually on your financial statements, but cumulatively, the impact nets out to zero. So this change is going to require you to consider how you're going to explain this to the users, because are they going to be able to understand in 1 year having a significant profit and with subsequent years of potential losses or reduction in profits. And also you would need to consider any potential inadvertent changes to or breaches in your covenants with any banks or associated bodies, because this will impact your profit. But the impact that's shown there could be reduced if you could create a lease agreement that had sufficiently specific performance obligations, as this will allow you to defer that revenue over the period of those obligations. So if those obligations annually matched the life of the lease, then you would have a matching revenue and amortization expense, and therefore no impact to the financial statements annually. If that's possible, that would be the very best way to obviously reduce the impact of the new standard. But if you're unable to add in sufficiently specific performance obligations into your leases, then the next best strategy might be to extend the lease for as long as possible. The reason for this is that the fair value of a lease should not be more than the fair value to purchase the item. If you had the option of entering into a lease for a newly constructed building with a fair value of $8 million and that it's estimated to have a 30-year life, entering into a 20-year lease or a 30-year lease is not likely to impact the fair value of the right of use asset significantly due to the time value of money. Without very specific details and the skills of a professional valuer, it's difficult to produce an accurate example. But if you assume a $700,000 annual rent increasing at 3% a year was the fair value of the lease payments for this $8 million building, after 20 years, the present value of those lease payments would be just over $8 million. Therefore, there is unlikely to be a significant difference in the right of use asset for a term of 20 or 30 years in this example, as the fair value is likely to approximately be around that $8 million. So on these facts, if you had a 20-year lease and an annual amortization of the right of use asset would be $400,000, being $8 million divided by 20. But if it was a 30-year lease, that amount would reduce to $266,667, being the $8 million divided by 30. So it would be best, if possible, to have leases for periods as long as possible, assuming there's no significant fair value difference of the right of use asset due to extending that period. But just a quick note that there is a potential impact for the lessor in relation to providing the lease at below market rates for the effective life of an asset. The lessor will have to consider if this would trigger any potential impairment for them. This is another significantly complicated area and outside the scope of what we're talking about now, but it's definitely worth mentioning. Although you may want to enter into a long-term lease, the lessor may not be as willing as they have to consider the impact to them. This is also another area where we're discussing with the AASB to see if they're able to issue some more guidance, particularly for the not-for-profit sector, and we'll let you know if we can get some more clarity in this area. The transition requirements, so a little earlier I mentioned that there's a potential to have some of the impact of this standard to be reflected in the retained earnings due to the transition options available in the standard. There are two options to applying the new standard: the full retrospective method and the modified retrospective method. Under the full retrospective method, you restate the comparative and make a cumulative adjustment to the opening retained earnings position to the earliest comparative period presented. So if you're first applying this as at the year ended 31 December 2019, the comparative period for this would be 31 December 18, and the opening equity position for that year would be 1 January 18. This method also requires a third balance sheet to be presented in your financial statements. So if you're a 31 December 19 year-end reporting under this method, you would need to have three balance sheets: one for December 19, one for the comparative period December 18, and that additional one for as at 1 January 18. The full retrospective method will require obviously a lot more work in relation to disclosure in the financial statements, and there are minimal reliefs available to be used for you if you're using this method rather than the other method, which is the modified retrospective method. The modified retrospective method allows the cumulative adjustment of the changes due to the new standard to be made to the current opening retained earnings position, and therefore no restatement of the comparative balances or the requirement to add a third balance sheet. There are also some other transitional reliefs items available if you use the modified retrospective method. This includes the ability not to account for leases where the lease will end within 12 months of the initial application of the standard, therefore 12 months within the 1st of January 19. And the other main transitional relief is the ability to use a single discount rate on all of your leases if they have similar characteristics. If I was preparing financial statements, I know which method I would be using. So also mentioned before, we'll talk about novated leases. This is relatively easy actually when you look at the facts of the cases, so it won't take too long to go through it. So a novated lease is where the employee enters into a lease arrangement with a finance company. Usually these are for motor vehicles, and to enter into a three-way agreement with their employer and the finance company, whereby the employer takes on the obligation of the lease. The terms of the agreement provide that if the employee ceases employment, the novated or the three-way agreement ceases, and obligations under the original lease will revert back to the employee, and the employee also has the risk of the residual value or the balloon payment. So how does the employer account for a novated lease arrangement? Well, the employer would not have to lease under the standards because this is not a contract, does not convey the right of the employer to control the use of the identified asset. The vehicle is effectively the employee's vehicle to use as he or she wishes, with the lease payments being a salary sacrifice to optimize their tax position. Earlier, we highlighted the guidance to the definition of a lease in AASB 16, which was in paragraph B9. This states that the assets to assess whether the contract conveys the right to control the use of the identified asset, an entity shall assess whether it has both the right to obtain substantially all the economic benefits from the use of the asset and also the right to direct the use of the identified asset. It is the employee, in this case, not the employer, who has the rights in 1 and 2, with the substance of the arrangement being that the employer is simply facilitating a tax-effective strategy for themselves to obtain a vehicle. So in summary, ways to reduce the impact of the new leasing standard. So start considering the impact now. Considering reaching out to the industry bodies to see if they can obtain advice for the sector for some specific circumstances, potentially get together with a number of other similar schools to obtain advice. But keep in mind that the best way to obtain any advice in relation to this would be to ensure that very specific examples are being used, and because the facts of each case are likely to be different, and that can result in a different treatment. Use your incremental borrowing rate to determine the interest in the lease, if the interest rate in the lease hasn't been provided to you, or where the lease payments are for non-commercial terms. Try and add sufficiently specific performance criteria into the lease, as this will allow you to potentially match the revenue with the amortization expense. Try and extend the lease period for as long as possible, as this will allow you to increase the period over which you can amortize the right of use asset, and in most cases the right of use asset will peak at the asset's fair value. And as mentioned a little bit earlier, you're not required to book novated leases, so therefore if you do need to obtain assets for staff, then consider novated leases. We do have potentially some time to look at some questions. I'm not sure if anyone's asked any at the moment, but that's okay. So someone's asked one. Just trying to look at the questions now. Just give me a second. Okay, so one of the questions here is, what happens when the building of the school and what happens when the building of the school are on the school's balance sheet and they have paid for the construction and only the land is in the balance sheet, which of a church, which is the owner of the property, both share the same overall site. So this is a good question. So this standard doesn't just apply to obviously buildings, it does apply to land and buildings. And if you've got the right to use the land, then the land will become the right of use asset. So you'll have to determine what that is. So if there's any contracts in place that have terms and conditions in it, or if there's no contracts in place, well, what's the implied terms and conditions? So this is why you sort of need to look through every single item that you have, regardless of if there's a contract in place, to try and work out what you need to do with it. So yes, but that definitely will still cause an issue. So you still have to obtain some sort of assessment of what the fair value of that arrangement would be. Okay, so go through, could I please go through maximising the term of the lease again? So the longer the term, the better. Wouldn't the net present value be really high and be a hit in the first year? So the reason for increasing the term of your lease is purely around what the fair value of the lease would be. So the standards obviously don't provide a lot of guidance in this area, so we're sort of still trying to work through it all. But the expectation would be that if, say, for example, you were to lease a piece of land and that land is worth $5 million, you would either buy that land if it was economically viable uh, for $5 million, or you would lease it for a period of time. So the fair value of that lease repayment shouldn't be more than the fair value to purchase the land, because economically you would make a decision to purchase and then fund it through your borrowings. So obviously there's going to be some differences here with borrowing rates and a few other bits and pieces as well. So the point of this being is to say, well, the fair value of the right to use asset, which is the asset that you have to book on the balance sheet, shouldn't be significantly different to the fair value of the land in general. So if that's the case, then regardless of if it's a 20-year lease, 50-year lease, or a 100-year lease, the fair value of that right to use asset shouldn't change, mostly because of the time value of money, but also because that the asset is only worth a fixed amount of money. So hopefully that will allow you to reduce the impact annually on your financial statements. Once again, thank you very much for your questions. I appreciate you considering those as well. So if you would like to get some more information on this or any other topics, obviously we have a number of avenues for you to do that. Contact your local BDO representative, ask somebody that you know, or myself if you'd like. Our website has a number of articles, and we also have some other webinars specifically in relation to the education sector. That brings us to the end, and the standard disclaimer at the end there, so I'm not sure if we'll have time to read it, but once again, look, I really appreciate you attending. Once again, if you do have any other questions, feel free to send those through. We'll get to them as soon as we can, but once again, thank you very much for your attendance.